Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day out there. Hey, I want to do a quick one here for you. So this is a series called Fin Tips, and you can look through our channel and kind of see all the previous ones as well. What we like to do is do quick, short videos to kind of go over something interesting or a new financial topic or something maybe you're researching and just want some quick help on. And I want to take it back to basics a little bit here today and talk about the tax advantages of different types of retirement accounts, because a lot of people out there, they're trying to decide what's best for them. It's coming up on 2020. They're all excited. They want to do something right. And they want to make the best decision for them because you're really locking into some of these plans, you know. So let's cover it here today and some of the confusion that I see around it. We're going to start with the 401k. So if you look at your 401k, when you make contributions to a 401k, that reduces your taxable income. For example, if you make $100,000 a year and over the course of the year you contribute $10,000, then your taxable income from your job, assuming you contribute to a traditional 401k, would now be $90,000. So your taxable income is $90,000. So every dollar you put in up to the max, which is $19,500 for those of you who are under 50, and of course $25 for those of you that are over. But so as you contribute dollars to it, you're reducing your salary. So what your salary is or whatever you earn, you're reducing it by the level of your contributions. That could be helpful, and that may be a great vehicle. The Roth 401k would be after-tax dollars. So if for whatever reason you make $100,000 in a year and you contribute $10,000 to a Roth 401k, your taxable income is still $100,000. Now, you won't pay tax on the Roth 401k in the future, but that's something you need to weigh and see what the difference is. Where there's a lot of confusion is when people have a 401k and then they use a traditional IRA or want to use a traditional IRA. Those don't work the same. So in a traditional IRA, you get a tax deduction, but it's not one for one however much money you put in. So you don't get to reduce your taxable income. You do get to put away pre-tax dollars, right? But this one's a little different, and it depends on where you land. So for example, let's say in 2019 here, you're married filing jointly, but you have a 401k at work. Well, if that's the case, or you even have access to a 401k at work, then you don't get the full deduction if your income is between 103 and 123, right? So what happens is, let's say you have $100,000 adjusted gross income, and you contribute the $6,000 to a traditional IRA, you'll very likely get the full deduction, the $6,000 deduction on that. If your adjusted gross income is like 110, well, that's between the 103 and the 123. So what happens is you'll get a partial deduction, but you won't get the full $6,000. You're still allowed to contribute, you're eligible and everything, you just won't get the full deduction. That becomes a concern going forward because some of those dollars are post-tax and now some of them are pre-tax. So you want to keep track of that if you're in that, what they call phase-out range. If you're married filing jointly and let's say you have no 401k, your range goes up to 193 and 203 as a family, married filing jointly. And so there's these different rules like that. But the point being, when you contribute to a 401k, dollar for dollar, no questions asked, your taxable income is coming down. Traditional IRA is not 100% the same way. You definitely want to know where you stand if your income falls in that phase-out kind of range. Now, for a Roth IRA, this is money that you're contributing that you've already paid taxes on it. And a lot of people ask me this question, do I pay the taxes at some point? Do I put money in the Roth and then I get a tax bill so it's all post-tax money? Nope, not at all. So when you put money into a Roth IRA, where'd the money come from? Came from your bank account, right? Which means it's already been taxed, right? At least that's what the IRS is assuming. You got a paycheck, you got taxed on your paycheck. The paycheck went into your bank account. You then took some of that money and you put it in your Roth. So there's not going to be a tax bill coming, but you just didn't get any tax credit, tax deduction, no reduction in your taxable income. You just basically have post-tax money now growing for the future, and you won't owe any taxes on it when you get to retirement. So a Roth IRA, much different than a traditional IRA or a 401k, is very similar to a Roth 401k, but there are some small rules there in terms of early withdrawals and taxes and stuff on all that. But that's how a Roth works. Now, the final one is a taxable account. So in a taxable account, often referred to as an individual account, a taxable account, a joint account, things like that, the deal there is there's no rules. So you can contribute anything you want. You can make as much as you want and still contribute to it. You can contribute as little as you want. There's no rules except the IRS says in a year where you make a profit, meaning you have bought a position and at some point in the future you sold it and you realize that profit, whether you bought it this year, last year, 10 years ago, whatever, in any year where you realize a profit, you will owe either long-term capital gains or short-term capital gains. Long-term capital gains are any position that you've held for more than a year and a day and you sold it at some point afterwards, right? So that could be, it's usually 15% is what people pay. It's a flat tax. And for that reason, a lot of people like that as for a retirement account. If you happen to buy a stock in March and sell it in April, that's a short-term capital gain, and that gain is taxed as ordinary income. So all the IRS says is do whatever you want in the taxable account. However, if you make a profit, we just want our fair share. And our fair share could be a long-term capital gain or a short-term capital gain. Now, in a taxable account, if you buy a position in, let's say it's December now, you buy a position, it grows and you make $1,000 between now and February, right? So if you own a position that has a value that's greater than what you bought, meaning you have a profit, you don't owe a tax just because you're holding a position. Well, if you vote for Elizabeth Warren, it seems like maybe she wants to do that. But at the moment, the tax law is you can hold it. You don't have to sell it and realize the profit. That's called an unrealized gain. Unrealized gains are not taxed. So you can hold the position as long as you like. When you realize the tax, that's when you'll owe that tax. So a lot of people, I'm finding more and more, people like to use taxable accounts for retirement accounts because they have the flexibility. They can put anything they want. And as long as we manage it in a way where you're getting long-term capital gains, that could be a smaller tax than ordinary income that you're going to pay on your IRA. See, in a traditional IRA or a 401k, when you take money out, it just counts as income. Whatever tax bracket you're in, right, that's where you land. Well, a lot of people say in a taxable account, it's 15%. Unless I'm not making any money at all, that's not bad. 15% beats my ordinary income tax rate. And so for that reason, it's interesting with these low tax brackets right now. It's interesting how many people opt to go for the taxable account. Anyways, that's all I have for you. Just wanted to keep it real short today. How 401k contributions reduce your taxable income. Traditional IRAs, close, but not really doing the same thing. Roth IRAs are all after tax, no real consideration there. And taxable accounts, of course, long-term or short-term capital gains. I hope that helps you in some way. Maybe you'll give us a call at Jazz Wealth if I can help you any more. We manage these accounts for our customers. And so if I just confuse the living daylights out of you and you say, I want to work with somebody, let them take care of it. I want to call them and ask them how things work along the way. As our customer, of course, you can do that. So I hope you'll check it out. You enjoy the rest of your day. Thank you so much for watching. If you would, hit the subscribe button. That really helps us out here. I appreciate that. And yeah, we'll talk to you soon. Thanks for watching.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.